Okay, we finally reached the end of chapter 3, where we talk about hobby losses. Now, this is a big item that we have to deal with when we talk about um, businesses, especially on the Schedule C. Now, under hobby loss provisions, taxpayers may not show a loss from an activity that is not engaged in for profit. Basically, if it's treated as a hobby, you can actually take up any income that you receive from the hobby. The expenses are only up to that income. That's basically it. So hobby income is reported as other income on line 8 of Schedule 1 of Form 1040. Again, I never understood why they put space between form numbers. That's weird. But yeah, so we can only basically take expenses up to basically the income that we receive. So it's a loss. I mean, not loss, basically a wash. Alright. So, when we look at hobby losses, or hobby itself, there are certain operational rules that end up happening. And for us to avoid this, hobby loss rules, we can show the activity was conducted with the intent to earn a profit. Because I can already tell you there's going to be a limit to when the IRS is going to look at your stuff. So, if you're going to determine to make a profit, here's the motives. They're going to look at whether the activity is conducted as a business, the time and effort expended on it. So, are you spending a lot of time on it or are you not? Are you just doing it on the fly? Dependency on the income for the taxpayer's livelihood. That's a good one. Whether losses are due to circumstances beyond the control. Okay. Attempts to change methods of operation to improve profitability. Okay. Previous success of the taxpayer in similar activities in the past. Whether the activity makes a profit in some years. And whether the activity is expected to make a future profit from the appreciation of the assets used in the activity. Basically, again, what we're trying to do is show that our main attempt, even though we got losses, is to make a profit. Well, the IRS will also bring this in. The tax law provides a rebuttal presumption that if the taxpayer can show a profit from the activity for 3 out of the 5 previous years, or 2 of the 7 previous years involving horses. That is like totally random there. But basically, you gotta show a profit 3 out of the 5 years. Okay? Then the activity is engaged in for profit. That's the simple part. If the IRS does not see that activity and they think that it's being a hobby, make a profit in 3 of 5 years, they're going to probably come for an audit. And if that happens, and they determine that it's a hobby loss, they are going to go back through your tax returns and switch and then charge you penalty interest for probably any income that you basically saved. So if you owe taxes, they're going to charge penalties and interest. They're going to figure it all out. So the key thing is to make sure you're running it as profit. Now, the TCJA also eliminated now miscellaneous hobby expenses as no longer deductible. Okay? So they have to be specific. That's all that it means. So really just be very careful. Make sure you're making profit 3 out of the 5 years. That you can show all the signs that your business is trying to survive. It's trying to make money. And if it's just out of your control, then that's what you do. You prove it to the IRS. Hey, this is just out of my control on the losses. Okay? So, this finally concludes Chapter 3. hopefully you enjoyed it. Apologize that I feel like I'm running down a little bit at the end. As you probably saw on the time, or you're going to see on the time, it's pretty late. But again, if you have questions, just please let me know.